watch it again. Yes, we can start now, I guess. Okay. Hello, everyone. Again, last week we lastly talked about franchising and licensing, and we discussed about their differences, right? License is transforming some knowledge or some products, use of some product or service or some knowledge on that to another firm and letting them use that property, so that's taking money out of that, gaining some royalty out of that. This is licensing. In licensing, generally, we see it in high-tech industries, in pharmaceutical industries, where there is a transformation of some knowledge, some new treatments, right? And or some pills that they can use and sell in some foreign market, And in these kind of licensing agreements, actually, there is not much control on the licensor, on the licensee, right? So when a licensee, a local company, take the rights of a licensor, in which is a foreign organization, they generally make a payment and use that license in their works. But in franchising, franchisor who gives the permission to the other companies have a more control on the other company. Okay, they actually transform their business model as well. The most general example for this, Starbucks, McDonald's, Burger King, these kind of international companies, generally they distribute some franchises. Okay, so if you can take the franchise from them, you can open up a McDonald's or you can open up a Starbucks coffee. However, you need to follow up their strict rules. You need to design your coffee shop or design your restaurant according to their conditions, and you need to operate your business as they want it. You need to use their business model. So the basic difference is that one is just a license that you can use it according to the contractual conditions, and the other one, in the franchise, you need to follow up the same business model, proposed business model, with some maybe quick or small adjustments according to the company, according to the country's conditions, right? But generally, they are same all over the world. When you go to a Starbucks in the United States or in Turkey, they most likely to look like each other, right? Their even their tables and their desks, chairs are similar to each other. Okay, with franchise and licensing, we talked about this. Now, another international business form I want to talk to you about. This is called contract manufacturing. In Turkish, we call it fason üretim. I think most of you guys are aware of this fason üretim concept. What is that? It is a big, let's say, a big brand wants to move their production utilities to another country. Okay, actually they are, let's say, an Italian company, Italian cloth manufacturer. Okay, they are making clothes, high quality clothes, but they want to produce that products cheaper. Okay, because in the European Union conditions, the production costs are too much, and they don't want to cost us. So they go to Turkey, let's say, or they go to India, China, somewhere, and they agree with a company to make their production. Okay, so then they can take this product from them and put their label on that. So it's very easy for them, and you don't need to go open up a company in another country, right? I mean, you don't make any direct investment. For example, you want to move your production facilities to China. It's a huge thing, right? You need to pay many money. You need to make investment. You need to arrange many legal requirements. You need to know the culture, know the policies. It's a very high costly thing. I mean, if you want to move all your production to another country. But however, if you can make an agreement with a local company in Turkey, in China, in India, wherever it is, so you can make an agreement with them. Okay, just produce me that, and you want that. Okay, you just list the requirements of that product. Just give me that productions. So you can take it, buy from them, put your label, and sell it. It's a good thing because you don't have to carry up your heavy startup costs, right? However, also labor costs are very low, and the main motive of this contract manufacturing actually labor costs, right? If you want to, for example, make your production in your own country, maybe your labor costs will be high, but if you move to China, it will be very low, so that you can compete in terms of cost basis. And also, another reason could be that maybe there's a huge increase in the orders. Okay, you have a factory that have some capacity, let's say 1 million units per year. Okay, but you are so successful, you make a good job, and your orders doubled, and the market requires you maybe 2 million units of production. Okay, and your capacity does not let you to produce that products. So you make an arrangement with another company that making a fason üretim for you, making a manufacturing for you through the contracts. This could be the reasons, but it's a very common thing, and Turkey is very famous about, especially in the textile industry. Many brands, worldwide brands, actually making their productions in Bursa, or other Anatolian cities, or in Istanbul, like Lacoste, Vakko, right? These kind of high quality brands are making their productions in Turkey, for example. And they are making their profits out of their brands, right? Actually, the quality is the same with many of the other clothes, but they are selling their brand. This is another issue. I mean, this is another issue that we will talk about in the marketing strategies and advertising strategies. But generally, this kind of manufacturing, contract manufacturing, is very common in international trade. Yes, let's move on another form, a joint venture. A joint venture, generally, sometimes there are some jobs that is not easy for one company to handle it. This expertise does not, for example, guarantee that they can do it. They need some other forms of expertise that they don't have. So they want to make an agreement, alliance with another company. Okay, so 2 or more companies, often from different countries, okay, come together to make a big project, let's say. We generally see it in very big government investments, like the third bridge in Istanbul. As you all know, we have finished it, I think 2 years ago or 3 years ago, right? A third bridge is opened, and also Istanbul airport is opened. So these investments, these jobs actually done by joint venture. Okay, not only one company take the job from the government and did all the job. Many of the companies come together, Chinese companies, Turkish companies, some engineering companies, construction companies. It's a very huge job, it's very risky. They come together, they build up joint ventures, okay? They form some companies and they did the job. There's a question, sorry. Good morning, hocam. How I can join the lesson? There is nothing mentioned about joining class. Monsina, I think you need to click just to join. It's online. Maybe one of you can help your friends if you know him or her. Okay, let me continue. Joint venture. Yes, it could be short-term or long-term, guys. It could be a project-based, like the Istanbul airport or Istanbul bridge. When you finish the project, the joint venture is, so you don't work anymore with that companies. It helps you to combine your resources and expertises. Maybe one company is very good at instruction. Okay, they are very expert. They have a very huge expertise on that. Another company have an expertise on engineering. Another company have an expertise on software, let's say, right? So they come together, they join their resource and expertise and solve the problems very easily. And also a joint venture must not be formal thing, okay? It could be an informal handshake between two companies. They can say that, okay, we will work together. Okay, we just make an agreement and we will help each other, okay? So there are forms of joint ventures which is informal things, just agreements between companies. Saves money and advertising. It is the advantage of it, because sometimes it is very hard for you to learn new as a company. For example, if you are an engineering company, you have most probably, let's say, an investment of 10 years, 15 years of industry knowledge in you, right? Or it's similar to an instruction company as well. So when they come together to build up Istanbul airport, they are using these expertises so that they can save some money. And also, in some cases, when they include some partners who have a good advertising capability, they don't need to spend that money, right? So they just make them their partners in a joint venture. So either creates a separate entity, they can create a new corporation in a joint venture. They could say that, okay, we are forming a new company, for example, company A and company B is forming a joint venture. They can create a new company C for a limited time, let's say. So it's a separate entity, separate institution, separate organization, okay? Or they just continue to their operations as they are separate companies, but they make an agreement, they make a partnership agreement. Both could be a joint venture example. Let's give some examples for you to make it clear for you guys. One of the reasons Zeynep asked something in joint ventures can be competitive advantage. Yes, it could be a competitive advantage as well, to especially in industries where there is a high competition. But generally, joint ventures are established in relatively new things, relatively new technologies, which is not that common and which is more risky. Okay, let me give you an example and you will better understand, I guess. For example, Volvo and Uber, you all know these both companies, I guess. Volvo is a very famous car manufacturer, and Uber is very famous a car taxi sharing company, right? So Uber, it's actually not, it's forbidden in Turkey, but in many parts of the world, Uber is an online taxi software that you can make very cheap taxi driving. You can find taxi drivers and you can be a taxi driver using Uber with your car very freely, very cheaply. You can just make transportation of the people. So what are these two companies are making actually? Okay, what is their joint venture? So they are trying a new technology, as I said it before. When it's a new technology, it is more risky. So they are trying to establish a self-driving car, okay, self-driving car without any driver. So imagine about a taxi, okay, there is no driver. You just get a car and it takes you wherever you want. I mean, it seems a little bit risky, right? I mean, in all this traffic and all these risks, there is no driver, just a computer is driving. So since it's a new technology, okay, Volvo wanted to take the help of Uber, who have more expertise in these GPS technologies, maybe, right? I mean, because Volvo, if they can do it themselves as well, right? They can invest in their R&D, research and development department. They can maybe find some engineers, find some software developers, hire them and to work them for you to develop this new technology. But instead, they want to make an agreement with Uber and use their expertise, use their knowledge on that. So they are working on this project. So they build up a joint venture. Okay. So yes, without driver, Mohammed, without driver. So in the near future, mostly we will see it in maybe 10 years, 20 years, the cars, taxis without drivers. Which they will be very safe. They will be controlled by themselves with the artificial intelligence technology, right? As you see, since it's a very new industry, since it's a very new thing, right? There are huge risks. And Volvo does not want to take it yourself. So it wants to make a contract, make an agreement with a relatively young company. Volvo is maybe 100 years old company, right? Very old company, very big brand. Uber is almost 10 years or 15 years at most, a company, young company. They know about. So they are coming together, bringing their expertise and creating something new. This is a joint venture for them. This is our example one. What else? We all use it every day when we want to go somewhere that we don't know. Google Earth, Google Map, or Yandex Navi, these kind of things. We use it a lot. So how they developed this technology in the first place? When we look at that, Google actually make a joint venture investment with NASA. Okay, NASA provided them with the satellite information. They are providing it with Google, and Google is providing their infrastructure, because everyone is using Google devices, right, in Androids or in other smartphones, so that people can access that information and find their directions. It's also a good example of joint venture. I mean, Google needed NASA, NASA needed Google to provide such a service. So they come together, they build up a joint venture. Another joint venture example, if you travel with airports, if you travel with Turkish Airlines, maybe you have realized that they are making an advertisement on, we are a member of Star Alliance. What's a Star Alliance? Actually, Star Alliance is a global airline joint venture. All of these companies come together, okay? They created Star Alliance as a new joint venture. So it does not need to be only two companies. It could be there could be more than 10 companies coming together to build up a joint venture. Tolga asked the question, would it be a joint venture if they produce a product that already exists? It could be, yes, but generally we can see that they are investing in new innovations, or they are investing in two big projects, like constructing an airport, such a big project, right? Because the same product, maybe it's not a joint venture. It could be, there are other forms of strategic alliances that we will see. They can select these. Okay, for example, they want to produce the same product as they are producing some clothes, and they want to produce it in Turkey. Okay, just making a contracting, manufacturing, fason üretim easier for them. Giving the money to the local company to produce it for you. You don't need to make a joint venture contract with them. You just make a regular contract. Okay. Joint ventures are generally first exist for big projects that is very hard for only one company can deal with, or new technologies that different companies, different firms bring their expertise and knowledge together. There are some benefits and there are some disadvantages of this joint ventures. What are these? Let me talk about you briefly. First of all, as I said, they are sharing the technology, they are sharing the risk. They are sharing their knowledge with each other so that it's cheaper for them to reach that technology. For example, Volvo, while they are making a joint venture with Uber, may think that if I invest this technology from zero, I will spend about that much money. If I just make a joint venture with Uber, I will spend this amount of money, right? So they make a calculation at Uber, making a joint venture with Uber is better for me, it's less costly for me, because I will use their technology. And also you are dividing your risks, right? Because if you do it yourself, you need to risk all of your money. But if you do it with more than one company, maybe you can share the risk. If there's a problem, let's say 30% of the risk belongs to the company A, 30% of the risk belongs to company B, and the rest belongs to company C, because all of them actually taking the financial risks together. Shared marketing and management expertise. Again, Volvo has a huge mass media advertising strategies, maybe because they are selling cars and they make some TV commercials. They make, we call it mass media marketing, classical, in the classical understanding, on the TVs. They are actually marketing through social media channels, maybe, right? Because they are more based on new technology, smartphone technology, and they don't need to make advertisements on the mass media. However, when they form this kind of a joint venture, this kind of a joint technology movement, technology investment, actually they can use their marketing strategies as well to make their advertisements. Okay, Volvo is using the Uber's channel, Uber is using the Volvo's channel, and it creates maybe a positive perspective, positive understanding in the market as well. Because when you see that these two companies are doing something, it must be something good. They are very successful companies. Volvo is very giving very importance to the safety, right? So maybe Uber may think that, okay, the main problem here, if you want to produce a self-driving car, let's say Uber think that, okay, not Volvo. The idea comes from Uber, let's say, and they think that it's very risky thing, right? Because we leave the human lives to computers, the human lives to artificial intelligence drivers. There is no human there. So how can we make sure that people are safe? And as you know, Volvo is very famous about their emphasis on the safety, right? Their cars actually high standard of safety, and for the last 50 years, only one person died in a traffic accident who drives a Volvo car. Okay, only one person or two persons. Very less number of people, because they designed their cars with a emphasis on human safety, and they also created the belts that we use, right? They created it. So Uber may think that I need an image of safety if I want to do that job. How can I make sure that? I mean, if I do it myself, people may not be very comfortable with that, right? Because Uber sometimes has some negative images all about safety as well, because they are using the some drivers may have an abusement on their passengers, and there are problems on that. But Volvo have a huge safety image, and maybe Uber wanted to do it with Volvo because of that, right? So they are, as you know, they are sharing their experience, they are sharing each other with their expertise, their image, their technology. So it's a win-win situation for both. Jumali asked the question, the F35 program. Yes, it's also a joint venture program, Jumali, because since it's a very high technology. F35, if you don't know it, it's a warplane project. Okay, so many together all over the world: United States, France, Germany, Turkey, maybe tens of more companies coming together to try high-tech warplane. So it's also a joint venture. Yes. Okay. What else? Entry into markets where foreign companies are not allowed unless their goods are produced locally. Sometimes, yes, you want to make an investment in another country, but they require that production must be based on our local companies. So you make a joint venture with a local company. That could be one of the benefits of joint venture as well. What are some of the drawbacks, some disadvantages of these joint ventures? So one partner company can learn the technology and leave the joint venture, become a competitor. It's always a risk, because when you form a joint venture, it's not that you are combining these two companies. Okay, actually these companies have their major operations separately, but for that specific project or for that specific investment, they are coming together. And there is always risk of losing your information, losing your knowledge or technology to one of the competitors. If something goes wrong, they can draw from the joint venture and they can steal the technology. It's a risk. The technology may become obsolete. Obsolete means old. So, for example, you formed a joint venture 20 years ago on some old technology, but it's not that attractive anymore. Okay, so you don't need to continue that. It could be. Sometimes the partnership may be too large to be as flexible as needed. As in big projects, there are maybe 10, 15, 20 companies coming together, and it's very hard to manage them, right? Because they all have different hierarchies, they all have different bosses, they all have different processes of production. So how can you arrange a way that you make them work efficiently, right? It's also a hard thing to do. It's a hard thing to manage a single company. So imagine that just convincing all of these other different companies from different cultures, different countries to work something common. It could be it could be a hard thing as well. Okay, another form, I think it's the last form, a strategic alliance. So what is that? What is strategic alliance? How come it's different from joint venture? Okay, it's actually a long-term partnership between two or more companies established to help each other build competitive market advantages. So in joint ventures, it's more specific, it's more generally it's established in complex things, like in a new technology or in a very big project, right? But a strategic alliance, actually, you just share some knowledge with another company, okay, to make more profit, to make a competitive advantage. So let me give you an example to clarify for you, okay? Again, a Uber example, and Spotify. Most of you are using Spotify. I know that. I think that. So they actually, what do they do? What do these two companies do? When you go to a Uber taxi, okay, when you open up Uber, they make an agreement. You can listen your Spotify lists in that car, okay. So it's a very actually small thing. I mean, it doesn't require huge investments, right? It doesn't require millions of dollars to build up such an infrastructure. Just they make a strategic alliance with each other, and when you go to a car, for example, the car recognizes you as a Uber profile. The car recognize you, and the car also recognizes your Spotify lists and give you an experience in that car listening to your own music. You don't need to listen to the music that the taxi driver opens you, but you are listening to your own music, whatever you select. So it's a good thing. It's a win-win situation for both of these applications, right? When you download the Uber, if you just synchronize your Uber account with Spotify, you can listen to your music. So this is an alliance example, good example of it. Another one, as you nowadays, most of us are using that, right? We are making our payments. In Turkish, we call it temassız ödeme. And you can do it by your smartphones as well. Our smartphones have a specialty that you can turn it into a credit card and you just point it to the machine and you can make the payment, right? How come it's possible? So Apple, while they're developing their Apple Pay system, they make a strategic alliance with Mastercard, okay? So you can synchronize your Mastercard with your device and you can pay with that. It's an example of strategic alliance as well. As you see, it's not that complex as a joint venture. It is not a huge breakthrough in the technology or huge investment which requires huge capacities. It's just a small adjustments in providing some service. Another interesting example I come up with while I am searching for some examples in the Google, and it's really something different for me. BMW and Luis Vuitton make a strategic alliance. Okay, so they think that they share the similar target of customers. They share the same audience, which is a luxury, rich people, right? So they think that when someone bought a BMW, a very high luxury car, they also give them a collection of Louis Vuitton bags, which is specifically designed for this BMW, which fits to the BMW's baggage in a very good fit. So they think that this collaboration increase their share values, create creativity, technology, innovation, and style. Okay, so they make an alliance with that. So when you are going to buy a BMW, you see that there are some luxury bags, and they ask you to, if you want to buy it with a lower price, it's a fit for your car, it's designed for your car, it's special for your car, right? So these kind of things actually are examples of strategic alliances between companies. So these alliances can provide access to markets, capital, and technical expertise of each other. Think about the example of our Apple Pay system, right? I mean, Apple needed a system that can connect their devices to the banks, and Mastercard has its technical expertise, right? So they make an alliance with them. They are using that. So they usually do not involve sharing costs, risks, management, or profits. And in joint ventures, they are sharing these costs and risks, right? But in strategic alliances, they don't share that risks. I mean, they just make an agreement. They give some money to Mastercard and take their technical expertise. Okay. And strategic alliances can be flexible and can be effective between firms of different sizes. I mean, as a very big company, you may a strategic alliance with small companies. Think about some small companies who produce some products to big companies like Hyundai, Toyota, Ford, Renault. So these big companies making specific agreements with that companies, and they are working for them. Okay, this could be an example of a strategic alliance as well. Yes. The other form, the last form, is foreign direct investment. Rather than making a contract with another company, rather than working with a company B, if the company A wanted to do it yourself, okay, I want to do it myself. I don't trust anyone. I just go there, open my factories, open my stores. I will work in there. We call it foreign direct investment. So you go in another company, buy some permanent property and businesses in that foreign nation. We call it foreign direct investment. And generally, large multinational companies, if they are using that strategy, they use foreign subsidiary. Okay? Foreign subsidiary is a company owned in a foreign country by another company, a parent company. Imagine it like that. Coca-Cola, okay? We have Coca-Cola Turkey, for example, and we have Coca-Cola Global. There are two different companies, but Coca-Cola Turkey is a subsidiary of Coca-Cola Global. In legal terms, Coca-Cola Turkey is a different company, but the Coca-Cola Global is its parent company. So they have a legal connection with each other. I mean, they're not separate companies as in other forms of strategic alliances that we see. They are not separate, but they have also some differences between them. Of course, in Turkey, because Coca-Cola Turkey is operating in Turkey, it has have a legal existence in Turkey, and it's different from Coca-Cola Global. But at the end of the year, they are moving their profits to Coca-Cola Global. Okay, so we call it foreign direct investments. Are we clear so far about these examples, about these different forms of international business strategies? If you have questions, you can write. I try to answer. So The legal requirements of both the parent and the foreign countries must be observed here while you are making a foreign direct investment, right? The advantage of foreign subsidiaries is that the company maintains complete control over any technology or expertise it may possess. Hamza asked the question, could I repeat the foreign direct investment? Hamza, okay, let me repeat it again to all of you guys. We talked about franchises, licensing, joint ventures, strategic alliances, right? In all of these forms, there are two different companies, okay? Okay, someone is singing. Yavuz, we are hearing you. Okay, let me finish the course that you can sing and we can listen, okay? Yes, control your microphones, guys. Okay, what I am saying. Yes, the difference between foreign direct investment and other forms of strategic alliances and international business forms. In all of the other forms, there are two different companies. They make an agreement to work each other, okay, with different forms. But it could be license, it could be franchise, it could be joint venture, it could be an alliance, it could be just a contractual manufacturing. But there are two different forms of companies. But in foreign direct investment, the original company who made the investment actually found that company, owned that company as a whole, okay? Own all the shares of that company, foreign subsidiaries. This is what a foreign direct investment. They make it yourself, themselves, okay? They don't want to make contracts. They make it themselves. This is what we call a foreign direct investment. Now it is clear. I hope so. If it's not clear, ask me again. Okay. So what is the advantage of this? Okay, foreign direct investment, making it yourself. You are maintaining the complete control over the company, over the other company. Okay, but what is the disadvantage of it? Sometimes there are risks, some political risks that we call expropriation. In Turkish we call it kamulaştırma. Okay, if there is a political problem, if there is an economic problem with that company, or if there is some bad things happen, sometimes that in the original country, that company could be expropriated. Okay, the local government could say that, okay, this is my profit, you cannot take it outside. Okay, or it's not necessarily be like a huge thing, but they may say that, okay, you have additional taxes, okay, and you cannot move out the money from my country, take it to your home country. Okay, you need to also give me my share. So this kind of problems could exist. Assets could be taken over by the foreign governments. It's a risk, especially it's a risk in the underdeveloped countries, like in some Asian countries, in some African countries, right? There are political instability, political instability exists. It's a risk of losing your property, losing your investments, right? Yes, so what is a multinational corporation? If a company, okay, manufactures their products in more than one countries, in many different countries, and has multinational stock ownerships. What does stock ownership mean? Stocks are the shares of the company, okay, who owns the company. If some company is owned by other nationalities, okay, let's say if a company's some shares are owned by the French, some shares are owned by the Arabs, some shares are owned by the Turks, and in our banking sector, we are very familiar with that, right? For example, in HSBC Bank, most of the shares are owned by a Hong Kong company from the Chinese company, or other companies like Finansbank, Guarantee, right? There are owners from Netherlands, from USA, from England, right? These kind of companies are multinational companies because owned by different nationalities, different companies. And only firms that have manufacturing capacity or other physical presence in different nations can truly be called multinational. Different strategies reflect different levels of ownership, financial commitment, and risks. I mean, just sell your products. If you just make imports or exports, okay, it does not mean that you are a multinational company. I mean, okay, you are selling your products to China, you are selling your products to Europe or US. I mean, it doesn't make you a multinational company. I mean, if you move some part of your operations in another country, it becomes a multinational company. Okay. Okay, let's move on the concepts of absolute advantage and comparative advantage. What was that? An absolute advantage, if a country produces some item more efficiently than all other nations, okay, or all other countries, we call it an absolute advantage. A comparative advantage, if they more efficiently produce that product from other companies. Let me give an example for this. An absolute advantage is we can name it Saudi Arabia. They have an absolute advantage on oil production, right? They have a huge natural resources. They are the #1 producers. No one have to compete with them. Okay. A comparative advantage, however, if you can, both of the countries can produce that. For example, Italy can produce olive oils, Turkey can produce olive oils. Which one has a comparative advantage in terms of production, right? If Italy is more available in terms of or more cheaply or produce that, they have a comparative advantage. If Turkey, they have a comparative advantage. Okay, it's a very economic thing actually. There are some economic calculations of this comparative advantage, but you don't need to go into very detail of this. Okay, but just can be familiar with this concept. That's enough. You have a question, I guess. What is the difference between global company and multinational company? Actually, the difference is the global company is selling or producing the same product in all over the world. We can give the example of McDonald's, okay, Coca-Cola. Their strategies are global, okay. They are actually producing the same thing in all over the world. Globally same. Multinational company, however, can adjust their production or services according to the culture they are operating in. For example, Danone is a yogurt company, we all know it, but Danone's products varies according to the culture from culture. When they go to Russia, for example, they have different sets of products. When they go to Europe, they have different. When they operate in Turkey, it's very different. Okay, so they are adjusting their strategies, they are changing their strategies according to the culture's requirements, culture's conditions. It's a multinational company. And sometimes you can just operate in small numbers of countries as well. Think about a company who only operates in Europe and Turkey, okay, on these two regions, but they are not globally effective. I mean, they are not having operation in US, in China, in East Africa, or anywhere. So this is the actual difference between them. A global company generally, very famous brands that you can imagine, operating in all over the world, and they make almost a similar production. They provide similar services. I hope I can answer your question. What are some indicators, economic indicators for the showing us the development of the country, right? You know imports, exports, but you don't know maybe the balance of trade and balance of payments. Let's look at the balance of trades. So it's the total of a country's export minus the total value of imports, right? If there is more export than more import, you have a surplus. If there is more import than export, you have a deficit. It's a financial indicator that is the of the country. For example, China has announced that they have a surplus in their balance of trades, which means that they make a huge export than their imported products, which means that more money come into that nation, right? It's a good thing, a balance of trade. But in Turkey, it is generally face balance of trade in a sort of deficit. I mean, we make more imports than the exports. And in our last months, I think it's changed. Some months we have a surplus, some months we have a deficit, and we will see at the end of the year if we have a surplus or deficit. So balance of payment is the more a broad indicator. It includes all of the money flows, okay, cash flows. What are other cash flows than trades? I mean exports and imports. Actually, the basic thing is credits, okay. If you take some credits from other companies, and I mean, if you can take loans from other banks, other countries' banks, it's also cash flow into your country. So balance of payments includes all the monies other than import and export, okay. Yes. Let's move on the trade restrictions. So global trade is a good thing, right? It gives you the opportunity to sell your products in a bigger market, it expands your scope. However, sometimes because of some political or economical concerns, governments may restrict that trade. Okay, it's not that easy to just take your production, go to Europe and sell it, right? There are some procedures, there are some obstacles. What are these? Let's talk about it. First of one is tariffs. In Turkish, we call it gümrük vergisi. If you import some good to your country, for example, I am the okay.
Pazarcı komşusuymuş yengemin. Pazarda.
Tamam, pazara gidecekseniz de sonra siz konuşun pazarları. Please be careful with the microphones. Okay. Anyway, the tariffs are the taxes. For example, Turkish government may think that I want to decrease the import level. Okay, I want to make more export because when something is imported very easily, it may give a damage to my own producers. How come? Let's imagine that you are all farmers. Okay, you are producing, let's say apples. Okay, and your costs to produce some apples per kilogram, let's say it's 5 lira. Okay, you can produce as Turkish farmers a kilo of apples for 5 Turkish liras, and you want to sell it for 10 Turkish liras to be able to make profits, right? So what can you do if some company or if some company from Bulgaria or in Greece or Iran, okay, just can come to Turkey and sell their apples from 3 liras per kilo. Okay, your cost is very high. You can only sell it on 10 liras, but someone just imported all of the products from another country and try to sell it for 3 liras. So as a Turkish government may want that, I want to protect my own producers. So I make a tariff for that, okay? So if you want to bring some product from China or from Iran or from other country, you need to pay some tax, okay? Because if you bring it very cheaply, you can damage my own productions. You can damage my own country. We call it tariffs, okay? Actually, it's very common in global trade, but there are global trade agreements which wanted to diminish the tariffs. Okay, for example, we have a agreement with European Union. Okay, in most of the products we just demolished all of the tariffs. We don't apply tariffs to each other in many products to increase the trade capacity. What else? Quota. Quota is you can limit the amount of the certain product. For example, you can say that, okay, in 2020, our traders can only bring 1 million units of that product. Okay, I put the limit as that. This is what we call the quota. Embargo. So a complete ban on imports on exports could be applied to a specific country. Mostly it's because of the political thing. So you can make an embargo on a country. So sanctions, in Turkish we call it yaptırım. We hear it a lot, whether the US government will apply a sanction of us, right? Because of some of the political problems or not. So it's a very bad situation for international trade, because if they make a sanction over you, for example, they can limit your international trade. They can say that to other countries, force other countries not to buy from you. So maybe you are aware of the sanctions against Iran, right? America apply a sanction towards Iran because of the nuclear program. So if you want to make a trade with Iran as a Turkish company, you may have a risk of facing these sanctions. You cannot do that. The America does not let you to do that, for example. So these kind of things actually make it harder for international trades. And sometimes governments help their own producers. We call it subsidies, subvention. Okay. For example, you hear that the government will give the farmers some subsidies. It's very common. For every kilogram of your production of, let's say, wheat or corn or any other thing, government help you. Okay, this is called subsidies. This helps producers to lower their costs and compete in the market well. There's a question. Is boycott can add into trade restriction? Yeah, boycott is actually not a governmental thing, but it's a consumer behavior. Of course, it can affect the trade, but it must be long term. I mean, boycotts are very commonly mentioned in the TVs in our things, but I have never seen that a boycott is going forever, okay, or going for years. For example, for many years in Turkey, we are talking about boycotting American products, boycotting Israeli products, boycotting French products. But none of them actually lasts for long. I mean, because people are buying, and so they really don't care about this political product. They just look at the quality, cost, and they continue to buy. But if you can turn it into a more effective movement, right? It can also affect. Other question: what if certain countries' export is less than its import, or vice versa? It will affect that country. Yes, it will affect. So balance of trade, actually, surplus and deficits tells us about that. If there's a surplus, it's a good indicator for our economy. So it says that you are doing good. I mean, you are producing and you are available to sell it to other countries. It's a good thing. If you have a deficit, it means you have some problems, right? Because you are spending more than you produce, maybe, right? And how can you finance this? If this deficit is small, maybe it's not a problem. But if it's too large, you will have more problems in the long run. Another thing is dumping. It's the unfair trade practices. It's, for example, China or Japan. Actually, they are doing this in the US market. Okay, let me show. Let me give you an example. For example, they are selling with a specific price. Let's say $10 a product for $10. But Japan government wanted to dump the US market share, the US government, the US market. So they decrease the price, okay? And they are selling their products less below the cost of the production. So when a foreign company came to your own country and selling it very cheaply to gain the market share, it directly affected the local producers, local companies. Imagine that you are selling some product, you are selling some furnitures, let's say, and suddenly a company bring huge amounts of furnitures from China and go into the Turkish market and selling the half price. So what will be the effect on the local producers? It's an unfair thing. You lose a lot, right? Because people try to buy it. So that governments actually apply the things that we mentioned, like tariffs, quotas. dumping, okay, they take some precautions against that. It's a protective thing against the interventions of other countries into your local economy. Yes, lastly, there are some trade organizations worldwide. Since there are these problems that exist in the international trades, these umbrella organizations, global organizations, they actually try to decrease these limits. They want to make international trade easier, because international trade actually creates more wealth, creates more jobs, creates more opportunities for people who are living in underdeveloped countries. I mean, an African country may not be able to produce their, let's say, basic products in terms of electricity, in terms of health, in terms of education, in terms of some basic technology, but international company can bring that technology, bring that thing to these parts of the world as well. So these trade organizations actually try to lower these trade restrictions. And as you maybe all realize, there is a trade war between US and China, especially the former President Trump try to apply huge sanctions against Chinese products. Okay, he applied tariffs, he applied quotas, he applied sanctions against Chinese products because he wants to protect his local economy. However, when they make it harder for international trades, okay, when you do it like that, actually the prices goes up. I mean, so everyone actually somehow have a losses. Okay, so international trade should be more freely treated, should be more easy, and these kind of organizations like World Trade Organizations, International Monetary Fund, Asia Pacific Economic Council, they all try to make it easier. These kind of blocks exist, trade blocks exist, European Union, NAFTA, North American, Asian, Asia, China, Russia, India, these kind of countries. They try to build some trading blocks and decrease these trade restrictions and make it easier. Okay. Yes, they want to improve world trade, as I said, protection of smaller countries that may not be able to compete, sharing of knowledge and technology. Also, these trading blocks may have some policy suggestions, okay, to protect some small companies, small countries as well. Like, for example, if you don't make any restrictions, maybe Chinese products will get all over the world, right? Because they make it very cheaply, and they have a capacity, high capacity as well in terms of their technologies. So they can make it better than any producer in Europe, any producer in Turkey, any producer in anywhere in the world, right? So they also try to make a balance between that as well, and also sharing the knowledge of technology, as I mentioned. Yes, and a way to shield the emerging nations from global economic instability. If you are too fragile, if you are too affected by the global changes, right, too easily, it's very hard for you. For example, since international trade today is very available everywhere, if you just leave producing your very basic product like food, right? Okay, I can buy it from another country. Why I just want to try to produce that, right? I can buy it from elsewhere. I mean, this is a very actually a touchy example in the March and April, when this pandemic is actually affected all of the world, right? Actually, European countries have a very hard time to reach out face masks, right? Do you remember that? Turkey is helping all of the European countries and even if the USA to sending them masks, right? Why this is happening, do you think? Why such a thing happened, do you think? What was the reason behind that? I mean, these big countries, they couldn't produce that, right? Why? Let me answer you. Since it was cheaper to buy from Turkey, India, they just didn't care about this before, right? Just a face mask, and I can buy it from China. I mean, building up a factory in France and trying to produce masks was not a feasible thing, was not a advantageous thing in that time. So they leave that production to other countries. But such a time came, it became much important, right? I mean, there's a lack of masks, no one can find it, and they needed to somehow find it, but they couldn't do it, right? But in Turkey, we see that because we have a huge capacity in terms of textile, we just produced a lot, and we can relatively overcome that problem more easily. So, I mean, international trade is somehow good thing, but in some strategic products, you need to also produce it locally, okay? Because in times of this crisis, for example, let's say there is a crisis in all over the world, there is a war, Allah korusun, but you need some food. If you are dependent on food to other countries, right? I mean, most of your people may be starved. They couldn't find food, they couldn't find bread. So you need to think about that. I mean, some strategic products you need to produce locally, or you need to at least have a alternative plans. Okay. Yes, there are some disadvantages of trading blocks. Exclusion. Yes, some countries are excluded from that blocks because of political reasons. They may have a decline of world trade because they have some conditions, right? And they have fewer consumer choice if markets are close to them. I mean, if you move on a block, trade block, and if you have a political problem, especially in this Cold War times, right? The Soviet bloc and American bloc times, European bloc times, actually some markets are close to some specific countries, right? They are trading like blocks, so consumers' choices were limited in that times. What would Europe did, right? They moved to a one currency for Europe in 1999. So actually it's easing their trade, right? They reduced annual exchange cost, that's $65 billion. Okay, so it's an example of international common trades understanding Euro. Lastly, the foreign exchange rates. Most of you realize that how important is that, right? As dollar is increasing in last days in Turkey. It's also an important thing because when currency rate is too much, you may have a problem, too much increase, too much volatility with that. Okay, this is the end of the lecture. I am stopping the record.